A very warm welcome to all the investors present here today. Today's event is something we've never done before. Real case studies, real examples on how to reallocate your investments to create generational wealth. Without giving away much, I would like to hand it over to you, Dr. Mohit.
Thanks a lot, Jason. Wealth can be an illusion. Today, I'm going to tell you how that illusion can turn into reality. But a lot of times, we believe that we are creating wealth, but it doesn't seem like it when we look at our balance sheets, when we look at our bank balances, when we look at our equity balances. We do a lot to try and create and generate wealth that we can leave behind to our kids as legacy, and then they can take it up from there, and then they can grow it and create over a period of time, over a period of generations, wealth. So there are three situations that today we are going to talk about. Situation number one is, let's assume that I were to walk 10 kilometers, but I still feel that I'm still there where I started from. Situation number two is that I walk 10 kilometers, but when I finish my 10 kilometers, I realize that I'm already at maybe 4 or 5 kilometers. I walked 10 kilometers, but I covered a distance which was only 4 or 5 kilometers. And the third situation is where I walked 10 kilometers and actually reached 12 kilometers. So now you can relate yourself and you can think which part of the situation you fit in. Whether you walk 10 kilometers and you're still there, whether you walk 10 kilometers and you actually covered only 4 or 5 kilometers, or you walk 10 kilometers and you actually covered a distance of 12 kilometers. The answer to all of this is what we are going to cover today, which is whatever hard work that we're doing, whatever income that we're generating, and whatever result that we're seeing, whether it is making us believe that we are sitting on a treadmill or it is growing faster than what we've covered or what we have decided to achieve. Now, with this note, let me also tell you that life is not about equities. Life is not about picking up the right stock. Life is about what kind of allocations you go in and how you prepare your life towards the end, where you realize whether you've actually created wealth or you've not created wealth. And most of us, and I'm going to show you some data that will shock you today, most of us would realize that what is happening is that the incomes are increasing, expenses are increasing, disposable income that we've got, which is something that we can invest, is also increasing, inflation is also increasing, but the net ROI is not increasing. The net return on investment is not increasing. And that is the biggest challenge for Indians, for investors, to try and see how we can change that. Today, I'm going to do a brief presentation to give you the context. I'm then going to pick up 20 investors. As some of you have given us your financial plans or your asset allocations, and we are going to discuss these 20 investors on a real-time basis in terms of what they can do to achieve their goals, which they have also given it to us. And we will go through case by case by case for these 20 investors. For the sake of privacy, I'm going to not take their names, but they will know that I'm talking about them because they would be on this particular webinar. I will be using their names as an acronym just to give them a hint that this is them, but I have, for the sake of privacy, removed their names. With that note, let us start today. Very interesting. I have committed a couple of hours on this particular webinar. I have also wanted to tell you to get your families in, because this is a once in a lifetime webinar that I do. I don't have the strength of going and doing 2 hours of webinars, but today I'm going to try and achieve that. But it would be great if you have your spouses, if you have your kids near around who can understand this topic, to just tell them that, okay, let's just spend an hour and a half on this to try and see what this guy is about to say. With that note, let us start the proceedings. A disclaimer, this is obviously not an investment advice. Nothing discussed in this webinar should be considered investment advice. We strongly advise all participants to check with certified experts before taking any investment decision. Market risk warning. Investment in securities is subject to market risk. Past performance should not be construed as a guarantee for future returns. An investment in equity and equity-related securities involve a high degree of risk, and users should not invest unless they can afford to take the risk of their investments. Now, just to tell you, I was a little cheeky on this particular webinar. Over the last 3 days, I floated 3 different topics to try and understand what kind of a topic that people would like. To an extent that I also said that I'm revealing 5 small cap stocks. 46%, almost 50% of the people who participated or decided to participate in these webinars are expecting 5 stocks. How to create generational wealth, 36%, and one learning that beats all gyan, 18%. These are the 3 topics that I had taken up today. I just wanted to understand where is the investor psyche. So I'm very happy for the 54% who chose to attend. The remaining 46% you may choose to leave this webinar. I am not giving any 5 small cap stocks today. I'm going to be talking about a topic which is 5,000 times bigger than these 5 small cap stocks which you may buy and make money, not make money. But today that is not the agenda. So this was just to try and understand what is the psyche of our investors, whether they are still following that opportunistic view of trying to make money in the shorter run, or there are investors who are actually trying to create generational wealth and thinking about how we can leave generational wealth for our children behind. So this webinar is for those investors. I'm sorry for being cheeky out here, but for people who are expecting 5 small cap stocks, they may decide to drop out from this webinar. Now, this is a very, very interesting slide. This is the India slide as a country. Where do Indians invest? This is not one investor, this is the whole country. Where is the allocation of savings in this particular country? If you look at the allocations in this particular order, it will not surprise you. Property is 60% of the savings. Bank deposits is 15%. Commodities is 7%. Equities is 4%. Debt is 8%. Cash, which is savings and current account, is 2%. And insurance is 4%. ROR is rate of return pre-tax. Now, I have taken the last 20 years as a case. And if you look at over the last 20 years, property has given on an average 5% compounding. Bank deposits have given around 7% compounding. Commodities has given around 13.5% compounding, but that is a result of the 100% increases that we've seen of the last 3-4 months. Otherwise, it will come to around 9%. Equities is 14% compounding over the last 20 years. Debt is 7.5%. Cash and savings is 2%, and insurance is 5%. I've done an assumption of, let's assume the total savings available with India is 1 crore, just for us to get the picture right. But this is real data. This is the way Indians save and invest. If I were to look at a broad tax of 12.5%, and I'm taking long-term taxes out here, right? And if I were to look at the 20-year average of CPI inflation, that is around 6.5%. So what is happening is very interesting out here. What is happening is this. Your 6.4% is the growth of savings, rate of return, pre-tax. Post-tax, it becomes 5.6%. And if you look adjusted to inflation, we are at a minus 0.85%. If you look at property, that becomes a minus 2%. It is not able to beat inflation. If you look at bank deposits, not able to meet inflation. If you look at commodities, 5% plus, equities 5.4% plus, debt just about flat, able to meet your inflation. Cash seriously affected by around minus 4.5%, and insurance at a minus 2%. So if you look at this at a India level, at a retail investor India level savings, the rate of return is actually negative. So what is happening here? Let's try and step back a little. What is happening is that there is, and if you remember how I started by telling you that this is an illusion. Wealth creation is an illusion. The reason it becomes an illusion is that you earn 100 rupees, then you earn 150 rupees, then you earn 200 rupees, then 250, then 300. So the illusion is that my income is growing. Your expenses are also growing. You want to buy a property, that also has to come in. You have to get your kids educated, you have to get your kids married, that is also coming in. Post all of this, what is remaining is the pool of money that I am investing, and that pool of money, I'm actually, if I were to invest the way I'm investing today, which is the corporate India investments that you see out here, I'm actually degrowing that money. So my illusion is that my income levels are increasing, but my reality is that my return on investment is a negative percentage marker. And that is primarily the reason why, as Indians, we've not been able to create disproportionate wealth, primarily because of the allocations that you see out here. Because if 75% of the money that we have made in our lifetime is in two asset classes, which is property and fixed deposits, 60 and 15%. And then we have debt at 8%. And then we have cash at 2%. The largest two asset classes which have given the biggest returns, which is 14% and 13.5%, our total savings allocation to that is 11%. 89% is not able to beat inflation. If that be the state of our investors, I'm very sorry to say that year on year, decades on decades, we'll become poorer on a nominal basis. When I say nominal basis, that means I'm not saying our incomes will decrease, but on a nominal basis, what we reap back to our investors or to our family is going to be much lesser and lesser. And that is the reason sometimes I get really frustrated when investors are only looking at stock selection and ye stock and wo stock and all of that stuff. But they do not understand this one simple grid. That what are you going to achieve? You are on a treadmill. You will go for 10 kilometers walk, but you would have not moved an inch from where you started. And that is going to be the biggest repent when your income stops. Because when your income stops, your inflow stops. And that's the time when you realize, oh my God, what have I done? And that's a very, very serious plague of misunderstanding that today we are going through towards our journey of wealth creation. Very, very serious plague that we are going through, all of us. Now, some of you are very smart. I'm going to discuss 20 investors today. And I'm going to discuss what they are doing and what they want to do. And with small tweaks, can we do some small tweaks with which they can look at their lives differently. But if this be the state, we are in very serious trouble. A rate of return of last 20 years of Indians is 6.4%. Post-tax, it is 5.6%. Real return, which is post CPI index, which is the inflation, is minus 0.85%. we are net negative on almost 5 out of these 7 asset classes. Only 2, which is commodities and equities, have given decent returns. And these 2, we have an allocation of just about 11%. So that is the sad state that we are at today. A simple slide, a rule of 72. 72 divided by the rate of interest will give you the number of years in which you will double your savings or your wealth. So if you look at cash in savings, you will take 36 years to double at 2%. If you look at approximately property, you will double it up in 16 years now moving forward at 4.4%. If you look at the average Indian portfolios, that will double up only in 13 years. I'm not even adjusting this to inflation. Average Indian portfolio will double up in 13 years. People who are investing in FDs will double up in 12-13 years. People who are investing in good debt allocations will double up in 9 years at 8%. Balanced portfolios will go at around 7.2 years. And obviously, equity heavy or aggressive portfolios can double up if you were to generate a 12-15% kind of a CAGR in 4-5 years as well. Now, the gap is that currently, as India, we are at a doubling up race of around 13 years. Right? When you double up at 13 years, the rates also double, because now if I were to calculate the same thing for inflation, it also doubles up. Goods prices also doubles up. So your ability to buy is the same what you were buying today at the same price. If you were to now look at after 13 years, you will be able to buy the same thing. If I'm able to buy a cup today with a certain amount of rupee, even if I spend double after 13 years, I will still be able to get the same cup, because the inflation has increased the price of this cup in 13 years to double. So the money that you have in hand, even after doubling it, unless you're doubling it at a faster pace, is not going to meet up with the expenses at that time. And hence, if you look at this one very, very simple statement, even though income is increasing, return on investment of Indians is actually negative, which takes away the whole multiplier effect. And that is the reason today we are going to talk about how can we break through with this particular paradigm. Some of our investors can break through. And how can they look at generational wealth creation, the creation of wealth that they can really call it as wealth left well behind for the next generation to grow it. And that's the reason I had requested all of you guys to get your families in this as well. So we're going to start the agenda. Now, one of the things that I discussed in detail some time back, I'm going to talk about it again today because this is my personal favorite. If there's anything that soothes me in adverse times, that is this particular slide. This is something that is my personal slide. And this is something that I want you to understand very simply. Whenever you feel there is a drawdown, whenever you feel there are difficult times, this is what you understand. No money can be created by having the risk capacity and appetite. It can be only created by having the risk tolerance. Now, what is the difference in these three? Let me just try and explain you. Let's assume that I have 1 crore money with me, which is surplus. I don't need it. I don't need it for 3 years, 5 years, whatever it is. And in some cases, it may be 10 lakhs, some cases may be 1 crore, some cases may be 10 crores, depending on who you are, right? So what that means is that, do I have the capacity of taking risk on this money because I don't need it on the longer run basis? Answer is yes in this case. If you have a liability, the answer is no. But if you have this particular capital available, the capacity is not a problem. Now let's look at the appetite. Do you have the willingness? Appetite is, do you have the willingness? And you will say, yes, I have the willingness. Because I have 5-10 years, I do have the willingness of taking that particular risk of that particular asset class, which is also fine. You have the capacity, you have the appetite of taking that risk. But the main difference is, do you have the tolerance? Which means that when the risk comes, do you shiver, or do you say that this is the time to allocate more money? And 99.9% of the investors shiver. You see that in volumes when the markets are down. You see that with the prices. You see that with selling that happens when the market goes up by 1%, 2%. You see that all the time, because people, the most savvy of the investors, whether you're a savvy investor, 30 years I've been investing, 40 years I've been investing, cannot give you this trait of having the right tolerance. The tolerance is that, yes, I can tolerate that risk. And that's the big difference in between me saying that capacity is fine, appetite is fine, but if you don't have the tolerance, sooner or later you will get out from the market at the wrong time, and you will get into the market at the wrong time for the wrong reasons, because the greed plays and the fear plays. Fear makes you take your money out, greed makes you put your money in. Both the cycles you are defeated, and you still call yourself as an aggressive investor. So tolerance. If there's one slide over the last 10 years that I will tell you to take a picture of this. Risk tolerance is one of the main things which makes or breaks the wealth journey, because you believe you can take the risk, but actually you can't tolerate risk. Right? People who can tolerate risk, I've met those also, and I can tell you there's very, very few investors who can tolerate risk. Otherwise, मेरा 1 साल हो गया पैसा नहीं बन रहा है, मेरा 2 साल हो गया पैसा नहीं बन रहा है, अरे ये पोर्टफोलियो थोड़ा ऊपर है, मेरा थोड़ा नीचे है, इधर से मैं निकल जाऊंगा, इधर ये कर दूंगा, उधर वो कर दूंगा. So that whole thing is what? Because you're just being out, you're acting out of greed. You're not tolerant to your risk that you've decided to take. People come in as ultra aggressive, people coming in as very aggressive, and then, after 6 months, after 3 months, they see a little drawdown and they run away from the market as if the dog is chasing them. Why do they run away? Do you think they don't have the capacity or the appetite to take risks? They have both, but they don't have the tolerance. They're never going to make money. Having 10 lakhs, 20 lakhs, 1 crore surplus that you can take risk is not the definition of making money. How much risk tolerance do you have on that? Because that makes you fight with volatility in the market. That makes you fight with drawdowns in the market. That makes you invest more when the drawdowns are there in the market. That makes you stable as an investor. That makes you brave as an investor, courageous as an investor. Otherwise, it's a myth. You may call yourself as aggressive, whatever you may call yourself. You may have goals which are very charming. They won't be achieved. Very simply, I'll cover this not in detail, but let's look at expected returns on asset classes. Little bit of futuristic in its own nature. If you look at cash, you should now look at 0 to 3%. If you're sitting in savings account, it'll slowly go down, more and more down. If you look at equity, depending on which side of the aggression you are, it can be 12 to 20%. If you're looking at fixed deposits, it would be moving forward in the 4 to 6% kind of range. If you're looking at property, that is from case to case basis. And if you're looking at maybe silver, gold, I would not project that at a 13%, but I can project that at a 9%. But for the sake of my cases, I will take real numbers. So I will take that 13% number, which is the number as we are seeing today. Some of the risk profiles, people can end up, this is pre-tax. So conservative people can end up at around 5 to 7% pre-tax, post-tax will be 5%. Adjusted to inflation will be 0 or negative. Moderate investors 7 to 12%. They can end up with a post-tax of around 8-9%. They are able to just beat about the index with maybe a couple of 100 basis point, say 2% or something. Aggressive investors who have the potential and they have the tolerance can beat the mark, can make around 15 to 20% on an average, say 15% post-tax. You are able to 100% do over the CPI inflation rate. And if you're looking at very aggressive investors, a different breed, which is according to me the epitome of risk tolerance, they can make a 20% plus, which means that generational wealth can be created in the last couple of categories. By being aggressive, it is not a question of being a small cap. It is not a question of being in micro cap. It is by being aggressive on your asset allocation. If you see the difference here, I'm not talking about a portfolio. I'm not talking about an aggressive portfolio or a very aggressive portfolio. I am talking about drastically changing your allocation of the surplus money that you have. So a lot of investors today think about मैं very aggressive हूँ तो मैं micro cap खरीदूंगा, मैं small cap खरीदूंगा. अरे भाई, अगर आपका 10% equity में allocation है, आप small cap खरीद लो, आप tiny cap खरीद लो, आप 10 रुपए का stock खरीद लो, पैसा नहीं बनेगा, पूरी जिंदगी नहीं बनेगा. Aggression is not played bottoms up. Aggression is played tops down, which means that what is my allocation strategy? An investor who would invest 80%, 70% of his money into equity and buys only large cap versus an investor who invests 20% of his money but buys only micro cap, the 70 to 80% investor who is investing in large cap is way more aggressive than the micro cap guy. क्योंकि 10-15% से wealth नहीं create होगा. 50-60% अगर वो ग्रो कर गया 10-12% से, तो 20% अगर आपने 14-15-16% से भी ग्रो कर लिया तो कुछ फर्क नहीं पड़ेगा. So aggression, risk profiling is never done at an instrument level. It is done as an asset level. What is the kind of investor? And some of the examples that will come today, I will tell you how are these investors in terms of their risk profile on a broad basis. With a disclaimer, I don't know them, I don't know their liabilities side, but I'll be able to tell you with my limited knowledge that where do they sit on the risk return kind of a paradigm. So what is the curse, a single digit curse? This is my 10x webinar that I had done around 4-5 years back, that if you are earning in single digit, you cannot create wealth in India because CPI is at 6.5%. Taxes are from 12 to 15 to 20%. If you talk about cap gains to long term to short term, मिला के consolidated 12-13-14% का टैक्स हो गया. सिंगल डिजिट मतलब 9%. अगर आप 9% पे ग्रो करेंगे, हाथ में पड़ेगा आपके 7-8%. उतना तो इन्फ्लेशन में चला गया. Then what are we doing? So single digit is the curse in India. We need to make sure we come into the double digit scenario. If you go at 12%, you will end up at 2x of your savings. If you go at 15%, you will end up at 3x. But if you go at 20%, you will end up at 10x of your savings. That is how the effect of compounding works over a period of time. But this compounding, as many investors typically think, is about selection of stocks. I am sorry to tell you, it is about selection of the right asset allocation in your portfolio. If this one thing can be understood by Indian investors, you will see how we spin out wealth for our generations. So that is the main difference that we're going to talk about today. Now I'm going to take some practical cases from real investors, live examples to make you understand what is happening. let's take example. Let's take first a survey. We of all the people who requested us to do a financial plan, the average age was 56. Right. So why is the average age 56? Because now you're reaching to a point where you're thinking about एक 30 साल वाला आदमी या 35 साल वाला आदमी अभी तक सिर्फ माइक्रो कैप और स्मॉल कैप ही ढूंढते जा रहा है, बिकॉज उसकी ग्रीड ही खत्म नहीं होती है. An average age of 50, 55 tells you that now you are getting scared because now you're coming towards your retirement age. Now you're coming towards putting your legs up. And now you're scared. What is it that I can do now in the next 15, 20 years when my income will go away? How is it that I'm going to survive? What is it that I'm going to spend? What is it that I'm going to leave behind? If this thought process was there with 30 years old or people who are 25-year-old, the situation will be different because, no matter whether you're too terribly successful in your professional life or not, wealth create ho jayegi. If you have the aptitude that we are today talking about. Age horizon is 17 years. They want a planning of 17 years on an average. Average expected return is 13% of the surveyors that we have. 52% of these individuals are aged 56 plus. 75% of these individuals have net worth of 5 crores plus, obviously because they are in their 50s. 69% have 11 years horizon. If you look at, broadly speaking, the asset class of this particular group that I'm going to discuss today, equities and properties are very similar, 38-37%. Commodities, which is gold and silver, is around 9%. Bank deposits 8%, debt 5%, and savings and current account 2%. I must congratulate you. This is maybe because of MarketsMojo. This is maybe because of the sessions that we've been doing. That at an India level, equity is 4%. You guys are still at 38%, which is huge. So you're already on your way of creating something very big, whether it takes 5 years, 10 years, but you're already on the way. Today we're going to sharpen some of the investors and we're going to look at what they have to say. Let's start. Before I start here, I have one important announcement to tell you. Model portfolios and portfolio optimizer in the next 4 or 5 days now, we are in the development process, is going to move out of MojoOne pack. When it moves out of MojoOne pack, that means new investors will not be able to subscribe to these two products. They will not be a part of the MojoOne pack. If you are a MojoOne subscriber, life doesn't change for you. You will see these two products in Mojo Infinity. New investors will have to subscribe these products at 1.5 to 2% charges, but nothing changes for you. Everything else remains the same. The only one thing that will happen that can affect your journey is that whenever your subscription expires, at that point in time, when you renew your package, you will not get model portfolio and optimizer. At that time, model portfolio and optimizer, you will have to separately pay up at a 1%, 2% of the assets that you're parking out there. It can be very, very expensive. And that is the reason today, or the last 3-4 days, in fact, we have resurfaced that 14,999 offer. It is for 1 year, but you're getting 2 years free. This is for you to extend so that your expiry is at least 5, 7, 10 years away. So you don't have to worry about paying extra once your subscription expires. And today the new investors also can avail of this particular offer, because once we switch off the model portfolio and optimizers, you will not be able to get in the MojoOne pack. So you are still eligible for 14,999 for 1 year, but 2 years free, which is almost a 85-90% discount that we're giving, especially for this disturbance that we're according to move into the Mojo Infinity platform. Nothing changes for MojoOne subscriber, but you can subscribe to this pack 2-3 times as well to make sure you have a long-term association and you don't have to pay on an assets basis. So there's a link that will be available out here. New investors can also do that till the time that we make this particular change. Let's go to our presentation. Mr. S, age 40, net worth 1.3 crores. Horizon, he's looking at 25 years. Expected return 11%. Investor query is how to reallocate the investments instruments for maximizing returns. I have a moderate risk appetite. He's currently got 85% in properties, and he's got like 3% in equities and 10% in commodities. Let's look at this investor. This is our first investor. So you have a total net worth of 1.3 crores, sir. This is your breakup. As you've given us 85%, which is 1.1 crores in property. Bank deposits is 0. Savings is 2%. 0. 3% in equities and 10% in commodities, which I'm assuming should be gold and silver. That is your 100% allocation. Your current rate of return pre-tax comes to around 6%. Post 25 years, your 1.3 crores with the current allocation that you're going will be around, say, 8 odd crores. Right? Now, if you're a moderate investor, I would typically try and change this proportion to try and see if I can reach to a 11% by still being moderate. But with a 85% in property, that is very, very tough. I would typically make this as, say, not more than, say, 45%. If I go to equities, if I were to just make this as 43%, I would typically go around a 10% return. If you want to play a little more aggressive, you would typically make this as 40%. You have a 48 here, and you have a 10%. Now, ideally speaking, I think we should limit it to this. Primarily because you said you're a moderate customer, but 85% on property is not going to get you anywhere, sir. So 85%, we have to get it down to 40%. The normal recommendation that I give investors is that your property should not be more than 20 to 25% of your portfolio size. 20 to 25%, at maximum 30%. Anything over that, you are sacrificing the return from the other asset classes. However, the difference is, prior to making this particular change, you would have typically in 25 years gone from 1.3 crores to, say, 7 crores, 7.5 crores. But with this change, there is a possibility, if the history continues, I'm not projecting out here, but I'm taking the same 20-year returns that these asset classes have given, that your 1.3 crores can actually, from becoming 8 crores, can become 21 odd crores. I will be sending you both these sheets. The sheets that you've given is obviously with you, but I will be sending you, sir, this particular sheet, so you can play around with the sheet and do. But you have a very, very heavy allocation on property, I must tell you. You must try and get it down from 85% to 40%. At a 48% in equities, with a 40% in property, you're still at a moderate profile. Let's look at another investor. DR, age 51, net worth of 20 crores. He's looking at a next 15-year horizon, expected return at 11%, very well balanced. If you look at property, he's got 20%, bank deposits 10%, savings 10%, debt 10%, equities 40%, and commodities 10%. Now, if you look at here, the only thing that I think your property allocation is perfect. The only thing that I don't know why you're doing it, I don't know, because you have some liabilities or whether it gives you peace of mind, but 30% of your money is in bank deposits, savings and current account. At 20 crores, why would you keep 2 crores in savings account, sir? And debt is 10 crores. So 30% of the money you are locking out here, and you are age 51, which is which is something that will give you a little bit of aggression out there. Now, your query is, I want to shift FD and excess savings into bonds to save annual taxation and use them to slowly shift to equities. Why? Why would you do that, sir? You are not here to save tax, you are here to make money. Right? So, I don't believe that moving into bonds, because you will move into bonds to a 1 year, 2 year, 3 year bonds, and then you're trying to save annual taxation to move into equities. Why would you do something like that? I personally am not in favor of that. But let's look at your sheet. That's your sheet. So currently at a 20 crore, because of your lesser allocation into properties, and you still have here, equities is 40%, you may end up at around a 9.6 kind of a pre-tax return over a 15-year period. When you look at a 15-year period, your 20 crores has the ability of becoming 92 odd crores in 15 years with this allocation itself. If your expected return is to 11%, these three have to give somewhere. Right? Even if I were to, for the sake of comfort, do 5%, 5%, 5%, and in this say add 10% and add 5%, I've added 10% here and I've taken commodities at 15%, you are at 11%. So whether you reach through putting in bonds first to save tax and all, that's your choice. But this is a very, very good 11% kind of a return that you can do out here, which is pre-tax on a 15-year basis. We are now talking about a 20 crore crossing 106 odd crores in your portfolio, which is a very, very handsome gain. And predominantly at the age of 51, when you are at the age of 66, if you can play with this particular plan, I think that will be an example of wealth creation that you would have left behind. So that's an excellent case that we have here. Let's look at another case. We have Mr. T, age 35, net worth is 1.6 crores, horizon is 25 years because he's 35. Expected return is 22%. Property is 0. I am assuming you are young, so you haven't invested in property as yet. Bank deposit is 5%. Equities is 70% allocation. Debt is 10%. And commodities is 30%. Your question is that once equity becomes 4x from now, I will shift 1x for a home, take a 60 to 70% home loan for 20 years, my equity can keep compounding. Let's look at this particular case and let's see what's right or what we can do about this case. So if you look at this particular case, let's look at your case, sir. So currently, where are you going to go, right? So if you look at 1.6 crores, let's assume that you're not buying, let's take first you're not buying a property. If you're not buying a property in 25 years, if you're going with this particular allocation that you have, you would end up at around 36 odd crores. From the age of 35 to the age of 60, you should end up at around 36 odd crores. Now you're saying that I would want to buy a property when this equity AUM becomes double. The thing out here is your expectation is 22%, which is a very, very high expectation. I personally feel it's more unrealistic than realistic, because 22% compounding over a period of 25 years is something which is very, very tough. Especially when you also want to buy property in between. A simple formula for you to look at how do I buy a property, which means let's assume that I do 15%. So in 4.8 years, my money typically doubles if I were to. So this is known as a rule of 72, which is 72 divided by rate of interest will give you in how many years your money will double. I repeat, 72 divided by the rate of interest. So say 3%, 6% or whatever it is. How many years your money will double? So in your case, I've taken, let's say, a 15%, assuming you're aggressive. So in 4.8 years, your money doubles. That means close to in 10 years, your money will become 4 times. Equity money will become 4 times. So with this assumption that you're talking about, you should be able to take a house at around the age of 45, where you will have a surplus of around 2 crores and the remaining can be taken as loan, which is 60 to 70%, and the remaining asset can grow. With that note, you need to understand that buying a property for the sake of living out there is obviously essential. Your allocation is aggressive, you are young, assumptions or expectations are very high. I would not take anywhere an assumption of 15%. Anything that comes, I'm not saying that you can't compound at 22. Anything that comes over and above that is gravy. But I should be aggressive even if you are doing 100% allocation out there, right? Because your EMI will start when you take a loan. So at the age of 45, with this assumption, you will be able to take, and you would still have a good enough 6 crores that will keep compounding at that particular rate of compounding that we have taken of 14-15% rather than 22%. Let's take the next case. Mr. GJ, age 65, net worth 65 crores, horizon 20 years, expected of 12%. Property is 50% allocation. Bank deposit is 13%. Equities is 30% and 7%. One of the things that you should realize is that as soon as you talk about anything which is in excess of 12% or 10% return, your property allocation and equity allocation are two main things that I will look at. So let's look at this allocation where you would end up in 20 years in terms of the wealth journey. Let's go and look at your case, sir. This is your case. Mr. GJ, age 65, time horizon 20 years, expected return 12%, net worth of 65 crores. I've given the proportion out here. If you go with the current proportion, your post-tax return would be around 8.6%. And after 20 years, this money of 65 crores would be around 444 crores. Your expected return is 12%. You're currently poised to grow at 8.6%. The only way you can reach there, if you were to ask me, is if you were to drop your 50 to 30%, and as your comfort, you increase equity to 40% and commodity to maybe 17%, and you are at a closer to 11% out here. You can possibly increase this to 12% and do equities of 45%, where you can inch towards a 11% marker. Now again in this, if you were to see, one of the joker in the card that we've got is this FD of 13%. That means that you've got almost 10 crores lying in an FD. Now I don't know, sir, what is that 10 crores lying in the FD? It is not contingency money for sure. It is lying there because of your comfort, or maybe you have to, get your kids married or whatever the case may be. But 10 crores is too high an amount. I would typically not, even if you were to play, the comfort level out here, maybe 5 crores is fine, but 8.45 crores is a very high amount to be lying out there. If I were to just make this as 7% and release 5%, and add back 17% out here, you'll be at a closer to 11%. So this is a little bit of a jugglery that we'll have to do. That property cannot be that high. I don't know the yields of your property, whether, because if you have such a large 20 crore kind of a property, maybe you are also investing in, you getting real estate, you're getting rental yields as well. But rental yields, if you were to get rental yields, then maybe if this can be a 6 to 7% with property and rental yields, you will be able to go to 11.3% still. I hope that makes sense. But your game has to be played very right, because if you see here, some bit of juggling that we've done out here, your 64 crores, which was becoming 220 odd crores, or rather, what was it becoming? 400 odd crores, is now becoming 634 crores. So there's a 200 crore alpha just about changing the allocation that we can do out here for you. So 2 suggestions for you: 50% property too high, get it in the range of 30%, increase your equity and your commodity allocation, and decrease your current bank deposits to maybe a 5 crore comfortable level from a 8.45 crores today that you have. Let's take the next case. BM age 80, net worth 5 crores, horizon 10 years, expected is 12%. So Mr. BM wants to reach to 90, age 90 with a expectation of 12%. Property, he's got 40%, bank deposits 10%, savings and current 10%, debt is 25%. So if you were to look at bank deposit, savings and debt together, that is 45%, which is the major blocker out here. At 45% in debt, this target is very, very stiff. Equities is 10%, commodities is 5%. Is my allocation okay, or it can be improved? Sir, it all depends on you. I don't know your liabilities. I don't know your situation. So all of this is with a disclaimer. Your allocation definitely can be improved. First, let's see where you're going to end in 10 years in terms of your net worth. Let's take your example. This is your sheet, sir. At 5 crores, in 10 years, you would typically end at a 6.9% kind of a return. If you are happy with that, that's great. But your expectation is 12% here, which is almost double of that. And you would, at the age of 90, you would typically have around 10 odd crores, which is you will, in 10 years time, only double your money with this allocation, which is 5 crores to 10 out here. Now, unless you have some dire need, my issue is these 3, which is bank deposit, savings and debt. Savings may 50 lakhs is at 2%, sir. Debt, you've got around maybe 7.5%, 8%. I don't know what you're getting, but post-tax is pathetic. So you've got 25% out here. This is my major play area, but I still won't be able to go to a 12% unless I play around with a property. So let me just first do what is the right thing to do, or what is normally what doesn't bite you that much. So let's say bank deposit 5%, savings 5%, and this is say 10%. Now I have 25% spare. If I can increase equities and commodities, so if I can increase this to 30% and commodities to 10%, I will go closer to a 9%. That's our option number 1. But your 5 crores, which was becoming 10 crores, has a potential of becoming 12.5 crores. The only way you can reach to a double digit is by reducing this and increasing your risk asset classes, but I don't know whether you would like to do that. This is option number 1. You can take a screenshot of this. Now, theoretically, you can reduce this to 20% if it is not a worthwhile asset for you. And you can increase this again to say a 45 to a 15%. That would be my last suggestion to you in terms of reaching to a 10.5%. But otherwise, I would not advise you to go anything beyond that. But you can be from your 8% return, you can go up to around 10.5% kind of return. Let's take another case. BJ, age 52, net worth of 1 crore, horizon 10 years, expected 15%. Very good allocation again. Property 20%, bank deposit 5%, savings 3%, debt 20%, equities at 47%, commodities at 5%. Please review my allocation and suggest improvements. Let's look at you, BG. Sorry. All right. Now, if you're looking at time horizon of 10 years, let me tell you that you're currently allocated quite decently. Your 1 crore is growing at around 10.2% pre-tax. And in 10 years' time, you would be almost at around 2.8 crores. That's how it's going to pan out. Yeah. It's a very decent allocation out here, and depends on, these allocations also dependent on what kind of risk you want to take. The only thing that potentially you can do is, I don't know why you're keeping 20% debt. If there may be a reason, then that's fine. But I would typically, if I were to take this to a 10% and increase 5% both here, which is make this as 52 and make this as 10%, you typically go closer to 11%. You will have a 20 lakhs impact out here, which is almost a 3 crores. But otherwise, you seem to be an aggressive customer. I'm very happy to see that your property allocation is about 20% and not more. Your bank deposit is fine, that much you require. Savings is fine. Debt, as I said, is higher. I have moved 5% in equities and 5% in commodities for us to reach there. So that should do the trick for you, around 11%. Now, if you decide to go to a 15%, then you'll have to do some drastic changes. You'll have to make sure, and logically in this you will not be able to do, because you will have to make your debt as zero and go very high on equities, and then you come closer to a 12% marker. And obviously, if you are an aggressive customer, then you come down to your portfolio strategy and see how you can align your portfolio to a more aggressive portfolio, and you make sure that this 14%, if you are able to generate a 16-17% return, then you can go closer to that particular amount. But that is something that depends on your portfolio selection and other things. But I think you can have a couple of 100 basis point improvement to where you are, and take this 2.6 odd crores to upwards of 3 crores. Let's look at next case. M, age 46, net worth 2.4 crores, horizon 12 years, expected 15%. Again, a higher expectation of 15%. Let's see, bank deposit is 21%. Savings is nothing, 3%. He doesn't have a property. 56% in equity and 20% in commodities. Age 46, expected, and horizon is 12 years, which is, I think you're talking about a 58 retirement age. Let's look at you, Mr. M. So, this is your profile, 2.35 crores. Currently, you're allocated at a very, very good 12% marker. If you were to pull this for 12 years, your 2.35 will actually come closer to a 10 crore marker, which is again a very good allocation. As I told you at the starting itself, very good allocation out there. There's not much you can do out here, apart from the fact that if you have this requirement in FD, you have to see what is your liability if you need 49 odd lakhs in your FD, because right now, whatever money you may put in for the next 12 years is very critical for you to take it out there. So even if I were to take it maybe to a 10% marker, it will do a little bit of a trick for me. I will not increase commodity to beyond 20% because it's going to be extremely choppy and volatile. But I will be able to increase the allocation to almost a 67, which takes me to a 13% kind of a return, and I think that should be good enough. As I said, anything alpha, anything over and above that is dependent on your equity selection of your products, of your portfolios that you're doing. People do make 20% as well if they are patient and they have the tolerance. And obviously people make even 6-7%. Some people can't even beat the index. But that can be a good strategy for you to cross over to a 10 crore marker. Let's go next. Mr. P, aged 43 years, net worth of 4 crores. He's looking at a horizon of 18 years. Expected is 12%. Property, very good. Proud of you, sir. 25%. Bank deposits is 5%. Savings is 1%. Debt is 0%. Equities is 51%. Commodities is 18%. I need to invest in USD since I'm an NRI for kids' education. Fees may come in USD in future. At the moment, I have no investment in US markets. So, Jason, is the query complete? Yeah, I didn't get your query. I need to invest in USD since I am NRI for kids' education fees and may come in USD in future. At the moment, I have no investments in the US markets. So you're an NRI, I'm assuming, sir. Let's go and look at your sheet. You have 4 crores. This is your current allocation. Property 1 crore, 20 lakhs in bank deposits, savings. Broadly, what you've given us is 4 lakhs. Equities is 2 crores. Commodities is around 72 odd lakhs. You're currently going at a 11.2% already, which is a great number. That means that, okay, now I'm going to read your full question. I need to invest in USD since I'm an NRI for kids' education fees may come in USD in the future. At the moment, I have no investment in US markets. So what should be the allocation of Indian equity and US equity? And please advise US equity will outperform Indian equity in the next 10 years. If better rental yield of 7-8% is available like market in Dubai, we can invest or this is temporary phase in UAE and rental yields may come down and better to opt for Indian equity only. I need to know more out here, sir, because you're asking about US versus Indian equity. Assuming that US and Indian equity typically mirror at around 12-13%. So this not, I think the equity allocation may not change out there. In terms of Dubai rental yield, your assumption of 6-7%, 6-7-8% is right. I think the appreciation may be lesser in Dubai, but the rental yields will stay out there at that particular, or maybe at a 6%. I will take as a assumption. I don't know whether this property is in Dubai or this property is where. So I have no clue. But still, even if I were to look at a 6%, I would typically not buy a property in Dubai at the cost of investing in equity. That's answer number one. Number two, whether you do allocation into USD, I would typically say that there should be some allocation to the US markets over the next, say, 10 odd years. If you're looking at 18 years, absolutely. But I would typically do normally, because your return expectation is 12%. I would typically do a 70-30 allocation maybe into India and into US, primarily because of the matureness of the market versus the growth market that India has got right now. That's broadly the allocation of A, don't compromise on equity allocation to buy Dubai property, primarily because of rental yield. And B, a 70-30 towards India and US for a global allocation. So these are the two answers. You are at a 12% already. At best, what you can do out here is I would typically be more, okay with a 15% kind of an allocation on commodities, and maybe a 54-55% allocation out here in equities. I think that's about it. But normally you're very very well priced in terms of how the allocation is done. Very 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 good allocation that you've done out here, sir. At this, over a 18-year period, you're talking about a 4 crores going up to around 31, 32 odd crores at a 12%. But please stay consistent in your equity allocation. Within this equity, as I said, you can do a 70-30 out here. But I would typically not tell you to remove money from here to invest in a property in Dubai. The rental yields is not a 6-7% is not what we are trying to chase here, because your expectation is at a 12%. With appreciation, I don't think so. The Dubai property, with the property as well as the rental yield, will deliver a 12% over an 18-year period. That's not going to happen. Let's go to MS, age 63, net worth 7 crores, horizon 5 years, expected 11% return. Property is 50%. Bank deposits is 10%. Savings is 5%. Debt is 5%. So 20% we've got in debt and savings. 25% in equities and commodities, 5%. Please review my allocation and suggest improvements. Sir, you are expecting an 11%, which is a little tough with this kind of an allocation. Let's look at your numbers first. This is where you are. So at a 7 crores with a 5-year horizon, you would typically go to 10 crores. Because you are with this kind of an allocation, I think what you can expect is a pre-tax around 8% kind of a combined asset base return. 5% on equity, on property, fixed deposit 7%. I have taken 2% savings. Debt at 7.5, 14 and 3. This has to go down. If your expectation is 11%, there's no way you can achieve that. Unless maybe, and then also you can't, but I'm not trying to shock you out here, but if I were to do 30% here, and if I were to do 10% in commodities, and if I were to do a 40% in equities, I don't know why you have so much money lying in these three. But if I were to maybe remove a 5% from your FD and do a 5% allocation here, and that is at best you can do, you can reach to a 10% kind of a return. So 30% in property, 5% in FD, savings and current debt, I have not taken out anything, 5% each. Equities has to go to a 45%, commodities has to be at a 10%. Again, these are discussions that I'm doing not as a firm discussion. Consult your expert or an advisor out here. I'm just broadly, I don't know you to give you this kind of an advice. I'm just talking about a generic allocation that is in front of me in terms of what generically one can do. But all of these numbers can change if your risk profile is conservative or if you don't want to do things in an aggressive way. And that is a completely right choice that you would take. But if I were to look at this, I mean, I would, 50% can even go down to 25% property. But even if I were to take it down to a 30%, you would typically achieve a 10% kind of a return. Your 7 crores, which was going up to around 8-9 crores, could go up to around 11.44. Let's look at next case. Okay, age 71. Net worth of 3 crores, horizon 15 years, expected return is 12%, 17% in property, and nothing else, primarily 76% in equities and commodities is at a 4%. Again, a very, very aggressive allocation by Mr. OK. I applaud you that you've been able to generate a very good allocation at your age specifically. Let's look at how your numbers stack up. Here we are. So your absolutely in line with your allocation, with your expected return. So if you are at a 3 crores, if you're looking at 15 years horizon, ideally speaking, you should be at around 18 crores at the age of 86. With the current allocation that you've got, which is property 17%, 77% equity, savings and current 1.7, and commodities at a 4%, you are at a 12.2% expected return on a longer duration period. On a 15-year basis, as I said, the 3 crores has the potential to going up to around 18.43 crores basis the historical numbers, which obviously may change, but this is as per all of these calculations are as per the historical numbers. So you're already there at a 12%, sir. I don't think so there's anything I can suggest you. I really like the way you're managing things. Please keep going ahead and keep doing the good things. Let's look at TRS. Age 75, net worth 5 crores, horizon 5 years, expected 15%. You got the highest allocation in property, which is 50%. Second is equities, which is 33%. Then you have 7% in bank deposits and commodities at 9%. Please review my allocation and suggest improvements. And his expectation is 15%. Tall expectations, sir, but let's see what we can do out here. Let's first look at where you are currently. You're currently poised for a 8.8 kind of a growth versus your expectation of 15%. Your 5 crores has the potential of in 5 years becoming 7.76, not even double, because of your current allocation. There is very limited things that you can do out here because you have majority 2 or 3 asset classes out here. But if I were to bring this to half, which is 25%, and if I were to take both of these up, let's assume I take this to a 15%, which is commodities, and I were to add this here, which becomes a 42%, you can go closer to an 11%. That's what can happen. Oh, sorry, I am still, sorry. This at a 52. You are at a 11.1% kind of a thing. Beyond that, you will have to get out of the property completely, which I don't know whether you want to or not. But I have reduced your property from 50 to 25. I have substantially increased allocation to equities to a 50% almost, and commodities to a 15% from where it is currently. You are then sitting at a possibility of almost a 8.5 crores at a 5 crore starting amount that you have today. Let's look at Mr. JG, age 66, net worth 5 crores, horizon 5 years, expected 10%, property 25%, bank deposits 25%, savings 5%, debt 10%. So you've got around 40%, sir. Itna acha allocation tha aapka. You have, I don't know why you're sitting 45%, almost 40% in debt with such smaller amounts of returns of bank deposits and savings. But you are sitting at a 40% in bank deposit, savings and debt. Equities 25%, commodities. What about bonds which are safe to invest? Okay, so now you're asking me bonds which are safe to invest. Expected return is 10%, sir. So let's first look at, I'm not talking instruments today, but let's look at where you are, sir, today. You are at a 8.7% kind of a projected basis the historicals that we've got out here. You have 5 crores, which has the potential of becoming 7.7 odd crores, which is 8.5% kind of a return. A 10% return, you have a large proportion sitting out here, these three. Unless you change something about these three, it would be difficult for you to cross the double digits. FD is 25%, savings and current is 5%, debt is 10%. Savings and current of 5% is fine. But if I were to remove a 10% here and instead of 25 have a 15% and take this to a 40%, you can get closer to a 10% return as per your expectation. So I haven't changed your property. I've just reduced FD of 10% and put that into equities, and you can get closer to a 10% marker out here. Let's look at next, which is Mr. MV, age 72, net worth 12 crores, horizon 10 years, expected 15%, property at 50%, the first big element, and then you have equities at 40%. The second one, rest is almost incidental, which is debt of 7%. Again, a very nice way to look at it. Is it okay to shift large chunk to silver and gold ETF? Is the question. Expected is 15% high expectation with a 50% lock in property because your property over the next 10 years may not deliver you a 15%, sir. And if that may not deliver you a 15%, it would be difficult to expect the rest of the asset classes, debt, equities, and commodities to deliver a 20, 25, 30% kind of a return. Let's look at your case, sir. Okay, this is where you are. Net worth of 12 crores. Your allocation of 50% in properties, 40% in equities, 7% in debt, and 2% in commodities is going to give you around a 8.99% kind of a yield on a 10-year basis. Your 12 crores has the potential of becoming around 30.29 crores. That's how you are placed today. 15% is very, very tough unless you lighten up your equity allocation. Your allocation in commodities is also very low. I personally feel that yes, you can take the ETF route for gold and silver. But I don't know how comfortable you are to reduce this particular allocation that you have. For the sake of mathematics, I can do a 30% here. And as soon as I do 22% here, you typically go to a 10% plus, but that is most that we can do. I don't even know whether you're staying in this property or it's an investment property. But having said that, that's where we're going to end. Otherwise, you are at a 9% kind of a thing. So I don't know how fair is it for me to assume whether you can reduce your property so easily. But otherwise, with this kind of an allocation, I think you need to invest more in the ETF side of gold and silver. It's a very, very small allocation that you have. Let's go to the next case, JKJ, age 37, net worth of 1.2 crores, horizon 23 years, expected 12%, decent expectations. At your age, property at 45%, bank deposit 8%, 45% in equities, remaining 2% in savings and current. I would like guidance on how to structure my portfolio to balance long-term wealth creation with near-term financial goals, especially how should asset allocation change with age, income stability and risk tolerance, and how should a portfolio be reviewed or rebalanced. Sir, you asked me everything together. मेरे को दो दिन लग जाएगा ये पूरा समझाने में, but I'm gonna maybe first look at where your case sits. All right. At 1.2 crores, it's a starting amount that you have today. You have 54 lakhs in property, 54 lakhs typically in equities. You are poised at a 9.2 kind of a return on a 23-year basis. This particular pot that we've got of 1.2 can go up to around 13.14 crores. So you're talking about 60 years at 13. Now, obviously, this is just this pot. Oh, I'm sure you, over the age, you will keep adding more and more money into this particular allocation. So your situation can be much better. You're not going to end with 13 crores. If anything, everything stops today, that's when your beginning amount remains the same. So most of you guys don't think that this is where I'm going to end. Is primary if you are somebody who's already retired and there's no income flow. But as in this particular case, he's only 37, and obviously the income will come for the next 23 years. So this can be a very, very large allocation. I must congratulate you. Although your amounts are smaller today, but your allocation is quite good. Please don't go out of reach on the property side out here. But on a 12% kind of an expectation, on a long-term basis, you should not be more than 30% on your equity. If I were to do a 30% on equity as a thumb rule for you without changing much, right? And if I were to do maybe add just this 15% in commodities, or if I add 10% here and just add 5% more in equity, you would see that I will reach closer to a 10.5-11% marker, and you would certainly see that 13 crores in this limited pool of money becoming 16 crores. So the good rule, since you are young out here, is that 30% is what you should cap on property, and remaining you should do a aggressive allocation because of also your age in equity and the commodity side. I've kept commodity as 10, can go to 15 also. I've kept equities at 50. You can be on your way for a good 11% kind of a compounding. Let's go next. RK, age 59, net worth 32 lakhs, horizon 15 years, expectation is 20%, sir. 59 years and your expectation now is 25 years. 20% is high. Equities is 75%. Bank deposits is 15%. No property. Savings and current portfolio बहुत ही volatile है. कैसे ठीक हो सकता है? सर, मैं इसका आंसर आज नहीं दूंगा. पोर्टफोलियो कैसे हो सकता है, पहले मैं देखता हूं कि आपका कैसे 15 साल के होराइजन में क्या हो सकता है. लेट्स सी दैट. आपके 15 साल में 32 लाख्स का इन्वेस्टमेंट है. अगर आप 15 साल के लिए जाते हैं इसमें, तो 32 लाख्स आज का जो आपको अगले 15 साल जो हो सकता है वो अराउंड 11.5-12% के आसपास हो सकता है. 32 लाख बन सकते हैं. 1,88,00,000 विच इज़ ऑलमोस्ट 2 करोड़ का अमाउंट वो हो सकता है यहाँ पे. 20% का रिटर्न इज expectation is too high, sir. I will not answer on that because that all depends on your stock selection, that depends on the portfolio that you do, all of that. As I said that the play that is there in this 14%, मैंने इंडेक्स का रिटर्न लिया है, लेकिन पोर्टफोलियोज का रिटर्न ज़्यादा हो सकता है अगर आप 15 साल पेशेंट रहें. पोर्टफोलियो वॉलेटिलिटी जो आपने मुझसे पूछी उसको कैसे मैनेज करना चाहिए, वो कभी मैनेज नहीं हो पाएगी. पोर्टफोलियो वॉलेटिलिटी हमें मैनेज करना अंदर आना चाहिए कि अगर पोर्टफोलियो नीचे है तो हमें कुछ ऐसा ड्रास्टिक स्टेप नहीं लेना चाहिए जिससे कि हम पोर्टफोलियो से बाहर निकल जाएं. जब पोर्टफोलियो नीचे आता है, अगर कोई और अमाउंट है तो हम डालेंगे उस टाइम. प्रिंसिपल एक ही है कि ये ऊपर नीचे लगा रहेगा, लेकिन जो चीज़ 20-25 साल से चल रही है, जो मार्केट है वो चलती रहेगी. कई दुनिया में तो 50 साल से चल रही है, तो 11-12% का रिटर्न तो बनता रहेगा. लेकिन वी डोंट हैव टू टेक ड्रास्टिक कॉल्स कि अगर मार्केट नीचे है, वॉलेटिलिटी है, तो मैं क्या करूं उसका. यू हैव टू वेट आउट इन अ पोर्टफोलियो ऑलवेज. अगर आप खुद मैनेज कर रहे हैं तो बढ़िया है, नहीं मैनेज कर रहे हैं तो गेट एन एक्सपर्ट टू मैनेज दिस फॉर यू. बट यू आर currently anyways poised with this allocation at around 11.8 kind of a percent. 20% का रिटर्न बहुत हाई एक्सपेक्टेशन है सर. दैट इज समथिंग दैट इज यू हैव टू थोड़ा उसको सॉफ्ट करना पड़ेगा. Let's look at Mr. SP, age 59, net worth 3.5 crores, horizon 21 years, expectation is 9%, property 10%, equity debt is 48%, okay, equities is 23%, bank deposit, and so you are basically, sir, 48% of debt, 2% of savings, which is 50%, and 7% of bank deposit. 57% तो आपका debt में है या बैंक में है. 10% प्रॉपर्टी में है, 23% और 10% इधर है. आई एम रिटायर्ड. आई हैव अज्यूम्ड द लाइफ स्पैन ऑफ 80 years. You will live beyond that, sir. Seek your suggestion for changes, if any, for a safe minimum post-tax return of 8%. Assuming average inflation of 6%, I have nil liability, floater medical insurance of 60 lakhs for my family. Okay, sir. देखें आपका कितना बनता है एज पर आर कैलकुलेशन. मिस्टर SP, यू आर आपका जो अभी है एक्सपेक्टेड रिटर्न उसी की लाइन में चल रहा है सर. 3.5 crores इज वेयर यू आर टॉकिंग अबाउट एज 59 यू एंड यू वांट टू गो अप टू 80. 3.5 crores can go up to around 27 odd crores which is a 9.2% post tax. मेरा सजेशन यही है कि आपका डेट एलोकेशन 57% पे बहुत ज़्यादा है सर, विच इज़ वेरी वेरी हाई. एम आई रीडिंग दिस राइट? या 48% इन डेट हियर. ये अगर आप थोड़ा कम कर लें तो वी कैन इवन इफ यू मेक दिस एज से 40%, थोड़ा सा कम करेंगे अगर आपको ज़्यादा कंफर्टेबल नहीं लगेगा तो, एंड यू कैन गो अप टू 31% in equity. If you do that, then you will be at a 9.7 or at almost a 10% marker. But if that is not comfortable, difference is not that much, 9.2 versus 10%, you are well poised for a 21 years, 3.5 crores going up to around 30 crores, sir. Let's look at next. TKR, age 70, net worth 8 crores, horizon 15 years, expectation is 15%. Whether my allocation is okay, of course I'm getting reasonable pension from my employer. My son is employed in Accenture US as senior manager. Myself and my spouse have reasonable health, no sugar, BP, etc. Till date. I have not taken health insurance policy. I have extensively walked 12 to 14 kilometers every day without fail. All right, sir. Thank you so much. I wish you all the good health and touch wood. आप ऐसे ही रहें. Let's look at where you are today. Very good allocation again. You have taken an aggressive route. 15-year horizon में क्या हो जाएगा? Because आपका aggressive वैसे ही allocation is very aggressive. Very proud to see you, sir, at the age of 70 to have this kind of an allocation. Let's look at what is here. आप सभी देख रहे हैं people who are on this particular can I have the screen please? People who are on this particular webinar, it is not about मेरा कब आएगा, right? It's about take the learnings from what investors are doing. These investors who have different ages, somebody 35, 37, somebody 70 out here. Look at the aggression with which Mr. TKR is playing. So look at various things when you make your own allocation. There is a lot of learning in other stories, and these today we have picked up 20 stories, and there's a lot of learning out here. Please, don't just wait out there, but look at all these plans very critically so that you know what is happening and what is the mindset of the investor. Now, this Mr. TKR's obviously, son is well employed. He's keeping himself fit. He's not taken health insurance, but he's saying that I don't want to. I have enough for me to cover up out there. I'm keeping myself fit. I don't have any problems right now. Now I'm trying to create a disproportionate wealth till the time I'm alive, 85, 90. Sir, may you live a long life. Let's see what happens out here. All right. So with your allocation, you are anyways at around at 12%. You have 70% in equities, and you have 15% in property. There's not much that I can do out here. You have very good allocation. Now, this kind of so you are already at a 12%, which basically means, just for the sake of numbers, 8 crores in 15 years can possibly go closer to a 50 crore marker. Now, in this kind of an allocation, which I find as a very, very good allocation, the only trick is that ये जो 14% है, this 14%, how do we increase? By making sure that we are rightly positioned in markets, because in 15 years you will get a 50%, you will get a 40% growth in a portfolio. Some of the markets you will get negative as well. So if the only way to get to a 15% is if you are ROI on equity is more than 15 or 14%, by which your portfolio decision making, your portfolio strategy becomes very critical. How aggressive you can make your portfolio. For example, just for the sake of example, I'm not saying this is what will happen, but let's assume that if you have a 18% kind of a compounding year, you go to a 15%. Right? So, and that is a very, very big number change, because if you had 14% from a 47 crores, if the portfolio is managed well, you go to a 74 crores. Almost a 70-80% jump on your net worth. Right. What that means is that your allocation, though, you've got it right, sir. Absolutely right. Now what you're trying to do is that what is the portfolio strategy? So if you're trying to manage yourself, see if you are managing well. If you want to look for an advisor, see which advisor you want to look at and where you want to allocate this, how much you want to manage yourself. If you're doing a good job, that's great. But even if you're not, see 14% though is the return the index has given over 20 years. So that though is there only. Now if you are doing active management, you will do 100, 200, 300 basis points better. But as soon as you do a 3-4% better, you are at your 15% target return. So you can do that. Let's look at next. Mr. AG, age 70, net worth of 7 crores, horizon 20 years, expected is 8%. Property is 30%. You are already going to cross 8%, sir. Bank deposit 10%. Debt is 8%, 47% in equities and commodities at a 5%. Let's go and look at yours, sir. Mr. AG, you are at a 10% expected with this kind of an allocation basis the historical returns that we've seen out here. 7 crores over 20 years can become 60 crores if you keep going like this. Let's look at your property is fine. Bank deposit 70 lakhs is fine at your at 70. You know that I'm assuming that you need that somewhere. Debt is also fine. 47% allocation is fine. The only thing maybe I can do to make this a little better. But why do I need to make it better? Because you already are expecting 8%, and I think you're well on your way for above a 8% kind of a thing. If you go like this, you may end up in a double digit, which is at 10%. My whole idea says that a 7 crore over 20 years can become a possible 60 crores if you were to go like this. Keep making sure that you stay to your allocation, sir. Very good allocation again. I'm just trying to see out here that most of the age, when the age comes in, the allocation is becoming right. So this is a very good sign that I'm seeing out here. Let's look at next. V, age 67, net worth 6.5 crores, horizon 15 years, expected 6%. Okay. Sir, 65% allocation and you expected only 6%. I can't find a better plan than this. Property at 20%, equities at 65%, and commodities at 5%. This is the first time I'm going to decrease maybe a little bit on the equities and breed that into commodities. But let's look at this allocation. Your expectation is 6%. You're actually going to go double of that with this allocation. 6.59 on a 15-year basis, if you were to keep doing this, what you're doing, should end up into a 37 crore kind of a marker. The only thing that I will do out here is that I would reduce just about 5% on equity. Even if the return comes down a little, just to stabilize my portfolio, I will put in at least 10% in commodities. So at 11.5%, expectation is here. I may just do maybe a 55% here, reduce allocation, and do a 15% in commodities just to be safe that I have hedges available, because most commodities and equities sometimes can move in the opposite direction. Yeah. With that, I think you would typically end up somewhere at around 36, 37 crores. But again, a very aggressive one and very low expectation of return of 6%. Let's look at MD, age 34, net worth 5 crores. Horizon 30 years, expected is 14%. No property. Okay, can I have the full question here? Because I don't see the full question. Mr. MD says, in previous webinar, it was mentioned either you are aggressive or conservative. There is no moderate. So what should be the ideal allocation to be really aggressive and maximize returns? I am okay with market volatility and having some years of drawdown, which I see as further investment opportunities by reducing debt. extremely wise things to say, MD, at the age that you are in. I'm very glad that you are on a very good track. You have a 70% allocation to equities, 5% onto commodities, and 17% onto debt. Let's look at your numbers first. All right. So you're looking at 30 years, you're talking about a big amount out here, because obviously you've created a good net worth at the age of 34. You're already at 5 crores of net worth. If you just go like this, your expected rate of return is 12%. You're going to end up at around 200 crores over 30-year period, after 30 years. Now, obviously, you're going to end up much more than that, primarily because this 5 crores also will increase disproportionately. You are at 34. So by almost 60 years, this will increase obviously disproportionately as well. So there is a 12% out here. I don't want to make this further aggressive. The only thing that I would do, the only one thing that I will do out here is I will, in this particular case, reduce this to 60% and increase your commodities to 15%. The pure reason, and there you have a 12%. The pure reason that I'm doing that, MD, is because these two asset classes, which is equity and commodities, sometimes can have a cross hedge. To create that cross hedge, you can be predominantly in equity, but there should be a 10-15% hedge that you need to create if you're very aggressive, right? Now, the second question that you have, what is the very aggressive approach? The very aggressive approach is limited to this in allocation, I would say. I will not go 100% into equities. But what I can do is try again the whole play that this is an index return of 14%, right? If we are aggressive in our portfolio strategy, and if we can take this up to 17-18%, you can end up with a 15 or a 14% return. So you have to now play. Allocation is fine. I've just created a cross hedge and allocated 10% more into commodities. What I've done is if I can take that 14% to 17-18% as a compounding over, say, a 30-year period, that's when the magic starts in a very big way. You're actually talking about almost a 500 crores of net worth. At your current level, you can actually be a 1,000 crore guy, MD. Very proud of you because you have age ahead of you, you have income ahead of you. So very well done. Let's go to the next investor. All right, sorry. So I've completed 20 investors. Before I go on to Q&A, portfolio optimizer and model portfolio are moving on to the AUA fees. As I said, it will not be available for new investors under the MojoOne pack. It will not be available for MojoOne users once their subscription expires. So we are giving you this limited time offer for 14,999 for 1 year. You can get 2 years extra free if you want to extend, to make sure that your portfolio, your MojoOne premium package is a long duration package, at least 7 to 10 year package, so that you don't have to give unnecessary 2% if your package expires. Please make sure, this is very critical. Please make sure that you listen to this right now and try and renew your packages or try and extend your packages as much as you want. We've seen over a period of time that when we do something like this, we keep going and talking for months and months. People at that time don't take an action and बाद में बोलते हैं ऐसा कैसे कर दिया आपने. So I'm giving you this offer. I'm actually giving you 2 years offer with the 86% discount, 2 years free offer. Please make sure there's a link out here. You can extend your packages. With that note, I've taken 1 hour and 44 minutes or 45 minutes almost. I can take some questions.
Okay, I'll pick this first question by Mr. Ramesh Mistry. He's dropped his queries a couple of times. Last 2 years equity returns are not 14%, then how can you guarantee 14%?
I am not guaranteeing anything, sir, 14%.
Yeah, even Infinity has not given 14%, then how can we talk about equity here?
Ramesh Mistry ji, did I say that I am committing 14%, I am guaranteeing 14%? I said during the webinar that this is a last 20 years average return that equities have given. It will give you 7%, it will give you minus 10%, it will give you 50%, it will give you 40%. No equity returns in markets are linear, sir. And please, I am again repeating, there is no commitment I am giving, sitting out here. I am only giving you 20 साल से क्या हुआ है, उसी 20 साल पे आगे मैं projection कर रहा हूँ. So there is nothing that I'm projecting that equities will grow at 14%. I'm not saying real estate will grow at 5%. I'm not saying commodities will grow at 13%. I'm not saying any of that. The understanding is wrong. My 1 hour, my 2 hours of efforts have gone down the drain, sir.
Okay, I'll pick this next question. This is by Balasundaram. Hello Mohit, thanks for the webinar with the analysis of actual investors. One thing I noticed was that even after reallocation of investments against the assets, the returns pre-tax was about 12%. In many cases, after tax, it may be around 8 to 9%. So is 9% the fair real life assumption we need to go with as the returns we are likely to get from a planned outlook perspective?
Yeah, sir. I think what your question is, Mr. Balasundaram, very, very interesting. I think what we've seen during these 20 cases that I've taken is that, asset allocation can deliver you a 12, 13 at maximum % kind of a return basis historically what these asset classes have created, which is typically maybe at 10%, 10.5% kind of a post-tax kind of a return. That takes you to the second stage of how you take the individual asset class returns higher. So can I take my property return higher? Can I get higher rental yield, for example? If I'm talking about commodity, what allocation between gold and silver I should have? Can I average it out at a higher level? If you're talking about equity, what is the portfolio strategy? Because ये तो index का return है. This is an index return, which means that if I were to invest in the index, I would have got 14% over the last 20 years, right? So, but if you are going into actively managed, can I make more than 14% or 15% or 16%? So then, today we have defined what is the limit of the asset allocation. But once you have the asset allocation model, then on the individual assets, you have to see how you can maximize the returns out there. So that is your second stage of doing that. But mostly people try and attack the second stage first and they never look at the first stage. So if I have a 10% allocation in equity and I'm trying to invest very aggressive, it's not going to yield me anything at an overall net worth level. So today we always talk about how to maximize wealth from the other side. The right way of looking at it is that if you are poised through your asset allocation at maybe a 9-10% post-tax kind of a thing, trust me, you will end up much higher. You'll end up much higher. But if you don't focus here and if you're chasing asset class kind of a return, individual asset class return, trust me again, you will end up at not even 6-7%. So that is the agenda. You're absolutely right, sir.
Okay, I'll pick this next question by Abhijit. Would like you to include in your session special planning for repositioning of existing investments in scenarios, one where world war without Bharat active in it, war with Bharat active in it, or internal prolonged unrest all over Bharat.
Sir, Mr. Abhijit ji, thank you for very interesting suggestions. I personally don't even believe that world war will happen. So, because if the world war will happen, you think I'll be, because, please understand, everybody's got a weapon for mass destruction. When you are sitting all with a weapon of mass destruction, life is not easy. Two people trying to sit right in front of each other and can cause equal destruction, and they both have the buttons, they both have the same instrument. That war will never happen. Is what I feel. That small infringements here, one country trying to invade and trying to do this and all of that with one person in focus typically today. Those are things that can happen, but I don't think so. We're in a world war kind of stage. That's one. And if world war happens, trust me, India has to be active in it. Because this is not something which is one country versus one country, that world war you're talking about. So why is that India will be saying that I will not participate? So India will get affected. Obviously, there are enough dynamics that play out here. But I can't do. I'm sorry. Maybe it is not in my knowledge framework today to do a projection of what can happen, and what kind of returns can and planning and reposition can happen basis that.
Okay, this next question by Sachin. Hello Mohit, thanks for walking us through the wealth journey of a few investors. Very insightful. I'm currently heavily invested in equity, almost 60% of my total net worth. However, I always get confused as how my direct equity can generate regular income once I decide to retire.
The only way it can do that if you have some dividend strategy, Sachin, out there. which means that you create a part of the portfolio which is appreciation plus dividends. So typically, if you have 60% in equity, maybe you can carve out 20% into dividend yield stocks, and you create a 20% dividend yield portfolios, a high dividend yield portfolio. Screener has, on our screener, you can get that. And you can create a portfolio out there which can keep giving you dividends over a period of time. That's the only way. Otherwise, there is no other way where you can have constant income out of equity. As I said, dividend yield portfolios can to an extent create that. And that is, I think, typically around, you can create a 6, 7, 8% kind of a dividend yield portfolio. Post-tax would be around a 5, 6%.
Okay, Mohit, that's it for the Q&A session.
Thank you so much. Hope you enjoyed. There are some investors who are left. If you want me to review their financial plans as well, we'll do that, and we will circulate these Excel sheets to you. We will also circulate an empty Excel sheet to you so that you can try and do your own projection as well. With that note, thank you so much.